Welcome to the Steadyhand Coffee Break, a shorter, snappier version of our popular hour-long Café series. Now, if you're new to our YouTube channel, I encourage you to check us out, and if you like what you see, be sure to subscribe so you can get notified of all of our new videos as they're posted. My name is David Toyne, and I'm the Chief Development Officer for Steadyhand, a leading wealth management firm here in Canada. Today, we're joined by Owen Winkelmolen, an advice-only financial planner who has appeared on two other popular Steadyhand Coffee Breaks, one that covers the Canadian Guaranteed Income Supplement, and the other about the new first-time home savers account that the Canadian government launched in 2023. Now, we'll link to those two videos in the notes below. Owen, before we dive into the topic of the day, please take a moment to tell us about your planning practice.
Yeah, so PlanEasy is an advice-only financial planning practice. There are no products, no commissions. It's just advice. And in particular, we focus on retirement planning. So, retirement income, taxes, benefits, and decumulation planning for average households. So anywhere with, less than 100,000 in assets all the way to $1 million to $2 million plus. And we help them just navigate different retirement rules, decumulation, and make the most of their spending in retirement.
Fantastic. And Owen, we'll also link to your website in the video notes below so people can check out your website. Now, I know that clients come to you to manage their accumulation and decumulation in as tax efficient a way as possible. So today, though, we're going to focus on the decumulation stage of wealth management and the top three things that you can do to extract as much as possible from your retirement income without paying taxes. And Owen, I think it's safe to say that for many Canadians, income tax might be one of their top annual expenses. And as you've written, it's likely larger than food or travel or even medical expenses. But as we'll find out today, there are a number of credits that are available in retirement to reduce taxes. However, too many Canadians may not be aware of them as they're dependent upon the type of income as well as someone's age. But there are three key tax credits that can add up to a lot of money. Well, welcome, Owen. Let's dive in. Can you start by giving us a high-level overview of how you advise Canadians on retirement tax credits? Like, what are these tax credits and how do they differ from deductions and other tax-related considerations?
Yeah, great question. So the way to think about a tax deduction is that it's lowering your taxable income. So it's lowering the amount of income that gets taxed on your tax return. A tax credit, on the other hand, it lowers the amount of income, the amount of tax you end up owing to the government. So after you calculate tax, a tax credit will help lower the amount that gets paid to the CRA. So they work slightly differently, but in retirement, there are a few different tax credits that become available that could end up helping you pay as low as zero tax in retirement.
Whoa, can't wait to get to that. But is it just to this distinction between deductions versus credits, is it fair to say that a RSP contribution is really a deduction, while a charitable gift, for example, is treated as a credit?
That's right, yeah. So an RSP contribution would be a tax deduction. It would lower your taxable income. In our GIS video, we talked about how that can be helpful for maximizing the guaranteed income supplement because that benefit is based on taxable income in retirement. Whereas a tax credit would lower how much income how much tax are you owe to the government come tax time.
Okay, thank you, Owen. Now, what are the things that you're looking for when you're assessing with your clients how to take advantage of the tax credits?
Yeah, so some tax credits will be eligible no matter what, but there are certain retirement tax credits that they depend on income, type of income, they depend on age. And so it could change even, during retirement, the type of tax credits that you're eligible for can change. So you could be eligible for certain tax credits in early retirement, and then come a certain age in mid or late retirement, you might have different tax credits that you're eligible for. So, it's important to understand what's out there, what exists. Now, all of these tax credits, if you're using a good tax, a tax program, tax filing software, these tax credits should be added automatically. But what we're talking about here is really pre-planning. So understanding what tax credits will be available in the future, and then planning your tax owing and income around that.
Okay, well, let's start with the number one credit. What is the lowest hanging fruit that Canadians should ensure that they understand?
Yeah, so basic exemption, that's your tax credit number one. So that everybody has access to the basic exemption. And we're going to be talking about federal tax credits. So it's important to understand that every province has its own provincial tax credits as well, which sometimes mirror the federal ones, but could be slightly different. Yeah.
Okay, but isn't the basic personal amount available to everyone? What's different for someone in retirement versus and decumulating their wealth, I should say, versus somebody who's still actively working?
Yeah, I think the big difference to appreciate is that when you're in the accumulation phase, your income is quite a bit higher. You might be earning 50, 65, 70, 80, 100,000 plus per year. And the basic exemption at 15, 16,000, every year goes up with inflation. So I think for 2024, we're looking at just under 16,000 as the basic exemption. It doesn't have as big an impact on your tax owing, but when you're in retirement and you have a couple and they're each earning 30, 40,000 a year in taxable income, all of a sudden the basic exemption becomes much more important from a tax planning perspective.
Okay, that makes an awful lot of sense. Well, I'm turning 65 next year. I have no plans for retirement, but I do think the next tax credit is going to apply to me soon. So you've got my full attention. Owen, what is the second tax credit that's available to Canadians?
Yeah, so the second important tax credit is one that's available at the age of 65. So this is one you're going to want to watch out for. And it's the age amount tax credit. So the age amount is a tax credit that's available to those over the age of 65. It's worth over $8,000 per year. So the tax credit's quite large. And again, at a federal level, you get 15% of that. So 15% of that 8,000 plus tax credit will help lower your tax owing for the year. So when we add the basic exemption and now we've got the age amount, we're getting up to, about $23,000 a year, $24,000 a year in, essentially tax credits, zero taxable income. And it's important to appreciate that the age amount is one of these tax credits that actually gets reduced if you have too much income in retirement. So once you start to creep into $40,000, $50,000 a year of taxable income in retirement, there's actually a clawback that reduces the age amount tax credit. And so you might see that if you've got quite a bit of pension income or RSP RIF withdrawals. So again, a good thing to plan for in advance is if you can stay just below that threshold, you can get the maximum age amount credit.
Now, Owen, this amount sounds suspiciously similar or close to the old age security. Not that I'm not focused on that, but and that's actually a term I take some offense to, old age security. But regardless, is this second credit tied somehow to OAS?
My guess is it's a coincidence, but you're right. So old age security is worth over just $8,000 per year at the moment. And you also are eligible for that at age 65. So, again, if you're kind of pre-planning for retirement income, you might be looking at the old age security. It's technically a taxable benefit. You might think that, I'm getting some more income, but I'm going to have to pay tax on it. But with the age amount tax credit also become eligible at age 65, that helps offset that extra taxable income, that extra tax owing. So, again, this is part of that pre-planning, looking at all the different income sources, where they phase in throughout the retirement plan, and then at the same time, what tax credits you might be eligible for.
Okay, so in this case, the government giveth and maybe they giveth again. Is the tax credit, like OAS, indexed to inflation?
Grows by inflation as well, that's right, yeah.
Okay. And finally, there's a third tax credit that's available to Canadians. What is that and how does it work?
That's right, yeah. So the pension income tax credit is the third interesting tax credit from a retirement planning perspective. Now, it's got a couple of qualification criteria, let's say. So pre-65, the types of income that are eligible for the pension income tax credit are different than if you're after age 65. So pre-65, the big one is any sort of income from a registered pension plan. So mostly, for your average kind of individual couple, that's going to be a defined benefit pension income. So if you have that before age 65, you will already be eligible for the pension income tax credit. Now, after age 65, the big one that becomes eligible is RIF income. So not RSP withdrawals, but if you convert your RSP to a RIF, then you can make withdrawals and it becomes eligible for the pension income tax credit as well. And I'll add one thing. So for couples, because pension income from a RIF or from a defined benefit pension plan is eligible for income splitting, both individuals in a couple can benefit from the pension income tax credit, even if they both don't necessarily have those that type of income. So you can split that DB pension income with a spouse, and you can both be eligible for the pension income tax credit.
Wow. So it's just a great reminder of how important it is to either become a teacher or marry one.
Teacher or federal employee. A lot of value in a DB pension plan.
Right. Oh, well, that's great. We've covered the 3 retirement tax credits in some detail. I know you've also done some work on how to generate up to $75,000 a year in retirement income and pay no tax, which is very exciting. So let's go through your thinking here.
Yeah, so it was a kind of a basic example where we went through the 3 different retirement tax credits, and then maybe a TFSA in terms of tax-free income in retirement. So the premise was for a couple, they both have 2 basic exemptions, 2 age amount tax credits, and 2 pension income amount tax credits. And the combination of those could easily be, $50,000 to $52,000 a year. So you have the basic exemption, $15,000 to $16,000. You have the age amount tax credit at between $8,000 and $9,000, and then the pension income amount at $2,000. And so if you're planning ahead, a retiree could have Canada Pension Plan, old age security, and then income from an RSP RIF that could meet that $50,000, $52,000 a year. And even though that's all taxable income, the tax credits will result in them owing no income tax come tax time. Now, that's about $52,000 a year in income. But of course, we've got this great account, the TFSA, and the TFSA can produce tax-free income in retirement. So because that account's been available for so long now, we see retirees with $150,000, $200,000 in those accounts. And I can only imagine that over the next few years, it's just going to grow to be $250,000 or $300,000 per person potentially. So there's this situation where a couple could have Canada Pension Plan, old age security, RSP RIF, and then 2 large TFSAs producing $75,000 a year in essentially non-taxable income throughout the rest of retirement.
Wow, that's fantastic. Now, how prevalent do you think it is that Canadians are aware of these opportunities to produce decent income retirement with paying little to no taxes?
I think a lot of people appreciate that these opportunities exist, but not necessarily how to map them out over their retirement period. So as I was saying, in early retirement, you might not have access to all of these tax credits. You might not have the right type of income. It might be before the age of 65. So this is where we might layer a few different types of retirement income together, and we might change the way we're layering those types of income depending on how old you are and when you started retirement. So somebody who retired at 55 or 60, we might have different sorts of retirement income, RSP meltdown, and we might switch to different types of retirement income after 65 or after 72. Every situation is a bit different, but creating that detailed retirement plan customized to your situation will let you take advantage of exactly what you have in assets versus what's available in tax credits or government benefits.
Well, notwithstanding your explanations today, Owen, and they've been fantastic, there is or certainly can be a lot of nuance in all of this planning. And of course, the tax codes are enormously complex and ever changing. So beyond engaging an advice-only planner to help, what other resources do you recommend that people check out?
Yeah, I think there's a lot of great advice-only planners doing this sort of work. So I would encourage you to kind of look at those different sources. There's lots of great YouTube channels, blogs from CFPs that are doing retirement planning on a daily basis. And even at PlanEasy, we just put out a case study with a couple with $250,000 in retirement assets and how they can maximize their retirement income. So there's lots of great examples out there of how this sort of planning could apply even to specific situations like that.
Okay, those are great ideas. And just before we end our video today, are there any other things that you would like to add relative to this topic?
Just the one would be that even though the tax credits are very attractive and they can be kind of a shiny object, it is important to sort of see the forest from the trees. Sometimes for lower income retirees, the guaranteed income supplement is more important than maximizing a tax credit. So often, we'll come across, individuals or couples in retirement who have started RIF withdrawals. They're getting the pension income tax credit. They're taking advantage of the age amount, but they're also causing themselves unnecessary clawbacks on the guaranteed income supplement. So although tax credits are wonderful, they're great to take advantage of. You need to have that bigger picture to make sure that really is the right strategy in your situation.
Right on, Owen. These are wise words from someone who sees a lot of Canadians' financial pictures. Now, Owen, as you know, but many others may not, we maintain a directory of advice-only financial planners on the Steadyhand website, and we'll provide a link to that directory in the notes. Owen, thank you very much for doing this video with us. We really appreciate your insights and explanations.
Yeah, thanks for having me on, David.